All right, let's just jump right into this explainer. We're actually going to skip any traditional agenda today, mostly because I really want to get straight to a harsh financial reality that, frankly, most people completely ignore. Look, if you've ever felt that sudden urge to jump into the stock market to make some fast cash, or, if you've been constantly checking your portfolio hoping to perfectly time the absolute best moment to buy, well, you are playing a game that is mathematically rigged against you. So today, we're breaking down the sheer quantitative superiority of indexation. We're going to look closely at the data, the mechanics, and the psychology behind why the absolute most boring approach to investing is undeniably the most wildly successful one.
So listen to this core idea. Most active stock traders fail because they attempt to time entries perfectly. But simplicity is your financial superpower. I love this because that concept literally flips everything financial marketing tells us completely upside down. We are constantly sold this Hollywood version of investing, right? The idea that building wealth requires super complex analysis, frantic daily trading, and flawless market timing. But the source material for today makes it incredibly clear. Attempting to perfectly time your market entries is the exact reason most active traders fail. They get lured in by the promise of fast money, but market timing is just a massive statistical trap. Actually, the real cheat code, your actual financial superpower, is profound, unwavering simplicity.
Think about it like two completely fundamentally different paths you can take with your money. Over on one side, you've got the active trader. Their entire world is defined by guessing. They're constantly sweating over financial news, trying to time their entries, desperately hunting for that fast money, and carrying this massive burden of intense daily stress as the market bounces all over the place. Honestly, it's an exhausting way to live. Now contrast that heavy psychological toll with the path of the index investor. Their world? It's defined by pure simplicity. They gain instant diversification, they remain completely calm during crazy market volatility, and instead of relying on their own frantic effort, they just let time do all the heavy lifting. One path demands your constant stressed-out attention and mathematically fails. The other demands almost nothing from you and mathematically wins.
Section 1. The Market Timing Trap and the Illusion of Fast Money.
So why exactly does the pursuit of fast cash actually trap investors? It's because it relies heavily on human willpower and perfectly predicting a completely unpredictable future. Get this, even highly paid hedge fund managers, we're talking professionals equipped with supercomputers, massive teams of analysts, and crazy insider access, they consistently lose to automated, passive index funds over a long time horizon. Just let that reality sink in for a second. The full-time pros on Wall Street fail at timing the market. If hedge funds consistently lose to passive strategies, it really begs the question, why on earth should the average retail investor try to guess? It is an empirical failure across the board. Trying to beat the market isn't just statistically improbable, it's honestly just a highly expensive ego trip.
And it's not even just about picking the wrong stock. It's about the underlying mechanics of active trading itself. Active trading inherently carries high fees and frequent trading leaks. When you trade constantly, you're getting hit with bid-ask spreads, slippage, and short-term capital gains taxes that just slowly, silently drain your cash. Plus, you pay a massive toll in high daily stress. Every single time you make a move, you lose a little bit of your capital to the financial system. Index funds, on the other hand, operate on low costs, automated consistency, and they generate zero daily stress. By just refusing to trade frequently, you stop those financial leaks. The boring consistency of a low-cost fund is vast and superior, simply because it acts like a sealed system where your money actually stays yours.
Section 2. Simplicity, your financial superpower.
An index fund is so much more than just a regular financial product. It's actually a profound behavioral mechanism. It is the system specifically designed to completely eliminate decision fatigue. It does this by allowing you to own the entire market and gain instant diversification without ever having to guess. You aren't hunting for the proverbial needle in the haystack anymore, you're simply buying the entire haystack. This is so incredibly powerful because it completely removes the need to pick individual stock winners, which takes just an immense amount of cognitive pressure right off your shoulders.
Now, what's really fascinating about this concept is how brilliantly straightforward the macroeconomic reality actually is. When the market grows, you grow. That's it. You don't have to wonder if one specific tech company is going to beat earnings this quarter, or if some retail brand is going to survive a massive supply chain crisis. Because you own a tiny piece of absolutely everything, you guarantee your participation in the overall upward trajectory of human economic progress. You capture the total growth of the market without any of that intense, anxiety-inducing monitoring that's required to track individual companies.
By locking in this strategy, you gain instant diversification and rock-bottom costs. And that directly leads to zero guessing and zero daily stress. As the source material points out, completely eliminating human willpower from your money management is the ultimate key to success here. By relying on this automated strategy, you successfully plug the financial leaks of high fees, sure, but more importantly, you protect your future self. You maintain a calm, automated wealth-building system that just runs entirely in the background, freeing you up to actually focus on living your life.
Section 3. Eliminating decision fatigue.
0. That is the exact number of daily decisions required when you adopt this approach. And this highlights a massive psychological payoff that goes way, way beyond just the financial math. Look, human effort eventually fails. Willpower is a strictly finite resource. Think about your own capacity to make good choices after an exhausting, highly stressful day at work. Now apply that totally depleted mental state to managing your life savings during a market downturn. Yeah, that is a recipe for absolute disaster. We get tired, we get emotional, and stress absolutely triggers bad financial moves, like panic selling. But when you set up an automated index system, it runs flawlessly, whether you're highly motivated or having a terrible day. Zero daily decisions literally means zero opportunities for you to let your emotions accidentally sabotage your wealth.
Consistency beats active trading excitement. We have absolutely been conditioned to think investing should look like a movie, right? People shouting on chaotic trading floors, fast-paced, aggressive decisions, the thrill of a massive overnight win. But that excitement is actually a total trap. The source notes that slow money always wins the race, and boring, predictable investments are what build real, multi-generational wealth. Excitement in investing is almost always a symptom of taking on unnecessary risk. Boring consistency, on the other hand, is the true time-tested path to building massive wealth.
Section 4. Let time do the lifting.
Let's think about how this actually builds across your lifetime. On day 1, the active trading mindset traps you in this toxic, short-term focus filled with media noise and daily stress. But if you step back and look at a 1-year horizon, you're building automated consistency. You are finally letting go of the daily panic. By year 10, your perspective shifts entirely. Suddenly, market corrections and dips aren't terrifying disasters. They just look like really cheap sales where your automated system gets to buy more shares at a steep discount. And finally, over decades, you reach the point where time truly does all the lifting. At first, compounding feels deceptively slow, but eventually the math flips. Your interest starts earning its own interest, the growth curve literally explodes vertically, and you achieve real financial freedom. Real wealth simply requires decades of uninterrupted time.
So the absolutely crucial point we want you to take away from this explainer is this: stop guessing perfectly. The illusion that you can somehow beat the market, outsmart hedge funds, and flawlessly time the global economy is exactly what keeps people broke and incredibly stressed out. Action kills fear, for sure, but the right action here is deliberately stepping back. Abandon the illusion of fast money. Stop hoarding uninvested cash out of a fear of the market dropping. And seriously, stop trying to perfectly time your entry.
It's time to choose boring consistency. It is time to claim simplicity as your ultimate financial superpower. So, I want to leave you with this thought. Will you keep guessing, or will you step back and let time do the lifting?